Welcome to the Generational Wealth Blueprint Masterclass. This is your comprehensive guide to mastering stock market execution and building wealth that lasts for generations. Whether you're just starting your investment journey or looking to refine your strategy, this masterclass will equip you with the fundamental principles and advanced tactics that separate temporary riches from lasting prosperity. Today, we're going to break down exactly how to build, protect, and grow generational wealth through systematic investing. The difference between being rich and building wealth comes down to one key principle: pay yourself first. This is the foundation that everything else is built on. Rich people earn money, spend it on their lifestyle, and save whatever is left over. The problem? There's usually nothing left. Wealthy people flip this script entirely. They invest first, automatically, before they see the money. Then they live on what remains. It's not about how much you earn. You can make six figures and be broke, or make $50,000 and build real wealth. The difference is prioritizing ownership and investments that grow over time. When you pay yourself first, you're buying assets: stocks, real estate, businesses. When you pay everyone else first, you're buying liabilities: car payments, restaurant meals, subscription services that you forget about. Make the decision right now. From this day forward, you invest before you spend. Here's a critical truth that most people don't fully understand. Cash sitting in savings accounts loses value every single year due to inflation. Let me put this in real terms. If inflation averages 3% per year, your $100 today will only buy you $74 worth of goods in 10 years. That's a 26% loss in purchasing power. Meanwhile, while your cash erodes, equity in growing businesses appreciates. Companies increase prices with inflation, grow their revenue, expand their operations. Your ownership stake grows with them. Over 20 years, the gap becomes absolutely massive. The graph on the screen shows it clearly. The purchasing power of cash declines steadily downward, while equity climbs steadily upward. This isn't theory. This is mathematical reality. Every day you hold excess cash instead of equity, you're choosing to get poorer. A reasonable emergency fund? Absolutely. But beyond that, your money should be working for you in productive assets. When you buy stocks, you need to understand what you're actually doing. You're not gambling. You're not trading numbers on a screen. You're purchasing a share in a real business. When you own Apple stock, you own a piece of Apple. When they sell iPhones, you profit. When they open new stores, you benefit. There are two fundamental ways to profit from stock ownership. First, equity appreciation. As the company grows in value, your shares become worth more. If you buy a share for $100 and the company doubles in size, your share is now worth $200. Second, dividends. These are your share of the company's profits, paid out regularly, usually every quarter. Think of dividends as rent from owning property, except the property is a piece of a business. Some companies pay high dividends, some pay low dividends, some pay no dividends, and reinvest everything into growth. All three can be valid strategies depending on your goals and the company's stage of development. Yes, the market goes up and down. Let me be crystal clear about something. That's volatility, not loss. Volatility is price movement. Loss is when you sell at a lower price than you bought. If you buy a quality business and the stock drops 20%, you haven't lost anything unless you panic and sell. In fact, if it's a great business, that drop is an opportunity to buy more at a discount. If you're investing for the long term, and you should be, these daily and monthly fluctuations are just noise. They're distractions. What actually matters is the underlying value of the businesses you own and their trajectory over decades, not days or weeks or even years. Warren Buffett has a great quote: "The stock market is a device for transferring money from the impatient to the patient." When you see red on your screen, remember, that's just the market being emotional. Your job is to be rational, systematic, and focused on the long game. Compound interest is the eighth wonder of the world, and once you truly understand it, it will change how you think about money forever. Small, consistent investments grow exponentially over time. This is not linear growth, it's exponential. In the beginning, it feels slow. Then it accelerates. Then it explodes. Here's a simple example that shows the power. Skip that $2 pizza slice every day. Invest those $2 instead. That's $60 a month, $720 a year. Doesn't sound like much, right? But here's where the magic happens. Over 30 years, assuming a 10% average annual return, which is roughly the historical stock market average, that daily $2 sacrifice becomes over $135,000. From pizza to six figures, that's compound interest. Now imagine if you increased that amount. What if instead of $2 a day, you invested $10 a day? That becomes over $675,000 in 30 years. This is how ordinary people build extraordinary wealth. Not through lottery tickets or get-rich-quick schemes, but through consistency, patience, and the mathematical certainty of compound growth. The DRIP engine, or dividend reinvestment plan, is how you supercharge compound interest. Here's how it works. Instead of pocketing the dividend payments you receive, you automatically reinvest them to buy more shares of the same stock. Those additional shares then generate their own dividends, which you also reinvest to buy even more shares, which generate even more dividends. It's a powerful snowball effect that accelerates your wealth building on autopilot. Let me give you a concrete example. Say you own 100 shares of a stock paying a 4% annual dividend. That's $4 per share, $400 total per year. Without DRIP, you pocket that $400. With DRIP, you buy more shares. Let's say the stock price is $100. You buy 4 more shares. Next year, you have 104 shares generating dividends. Then 108. The numbers compound. Over 20 or 30 years, DRIP can add an extra 30 to 40% to your total returns without you doing anything except clicking one button to turn it on. You don't need a fortune to start building wealth. This is crucial. So many people think they need $10,000 or $50,000 to begin investing. That's completely wrong, and it's an excuse that costs people decades of compound growth. The $500 entry plan is designed specifically for people who are just starting out. The goal isn't to get rich overnight with $500. The goal is to build the habit of consistent investing before you worry about having perfect knowledge or perfect timing. Consistency and quality matter infinitely more than quantity when you're starting out. Here's the plan. Take that $500 and buy shares of one high-quality dividend-paying company that you understand and believe in for the long term. Just one. Then commit to adding $100 every single month. Set it up automatically. Don't think about it. Just let it run. After 6 months, you'll have invested $1,100 and built an unbreakable habit. After a year, you'll have $1,700 working for you. This approach builds discipline, teaches you how markets work, and gets you in the game. Start small, invest regularly, and let time do the heavy lifting. Invest within your circle of competence. This concept comes from Warren Buffett and Charlie Munger, and it's one of the most important rules in investing. Your circle of competence is the collection of industries, business models, and companies that you genuinely understand. Not that you've heard of, but that you actually understand how they make money, what their competitive advantages are, and what could threaten their business. Stick to industries and companies inside that circle. If you work in healthcare, you probably understand healthcare companies better than the average investor. If you're a software engineer, you understand tech companies. If you're a teacher, you understand how education businesses operate. The further you venture outside your knowledge zone, the higher your risk of making expensive mistakes. Because you're not investing based on understanding, you're guessing. And mastery beats guessing every single time. Here's the good news. You don't need to understand every industry. You just need to deeply understand a few good companies and wait patiently for the right time to buy them. Stay in your lane, get really good at evaluating businesses in that lane, and ignore everything else. Don't chase stock price hype. Focus on the company's balance sheet. This is where the real truth about a company's health lives. The golden rule that I want you to memorize: cash reserves should exceed long-term debt. Why? Because a company with more cash than debt has financial flexibility. They can weather economic downturns. They can invest in new opportunities without taking on expensive loans. They don't have to worry about making debt payments during tough times. A strong balance sheet means the company can weather storms and invest in growth without financial stress. When you look at a balance sheet, here's what to focus on. Cash and cash equivalents. How much liquid money does the company have? Long-term debt. What do they owe? Current ratio. Can they pay their short-term obligations? If a company is burning through cash, taking on massive debt, and barely covering their obligations, that's a red flag the size of a football field. On the other hand, if they're sitting on a pile of cash with minimal debt, that's a company that has options. Options are power in business. Balance sheet strength isn't sexy, but it's the foundation of long-term success. Evaluate business health using 5 vital metrics: revenue growth, profit margins, return on equity, debt-to-equity ratio, and free cash flow. These 5 metrics tell you whether a company is thriving or struggling beneath the surface, regardless of what the stock price is doing. First, revenue growth. Is the company selling more products or services year over year? If revenue is flat or declining, that's a problem unless they're dramatically improving efficiency. Second, profit margins. What percentage of each dollar of revenue becomes profit? Higher margins usually mean better business models and pricing power. Third, return on equity, or ROE. This tells you how efficiently the company uses shareholder money to generate profits. An ROE above 15% is generally considered good. Fourth, debt-to-equity ratio. How much debt does the company carry relative to shareholder equity? Lower is usually better. Fifth, free cash flow. This is the cash a company generates after paying for operations and capital expenditures. Positive free cash flow means they can pay dividends, buy back stock, or reinvest in growth without borrowing. Master these 5 metrics and you'll know more about a company's health than 90% of retail investors. Asset allocation is about intelligently balancing your portfolio across different types of investments to optimize risk and return. This is where most people get it wrong. They either put everything in one stock because they're overconfident, or they own 50 stocks because they've heard diversification is important but don't understand what it actually means. True diversification reduces risk without sacrificing returns. It's not about owning as many stocks as possible. It's about owning enough different types of businesses that if one industry struggles, your entire portfolio doesn't collapse. Don't put all your eggs in one basket. If you only own tech stocks and the tech sector crashes, you're in trouble. But don't spread yourself so thin that you lose focus and end up owning a bunch of mediocre companies you don't understand. A well-diversified portfolio might have 15 to 25 individual stocks across different sectors: technology, healthcare, consumer goods, financials, industrials. Or if you don't want to pick individual stocks, index funds give you instant diversification across hundreds or thousands of companies. The key is intentional allocation, not random accumulation. A competitive moat protects a company from rivals and ensures long-term profitability. Think of it like a medieval castle. The wider and deeper the moat around the castle, the harder it is for enemies to attack. In business, a moat is any competitive advantage that makes it difficult for competitors to steal market share. Look for intangible assets like brand strength. Think Apple, Nike, Coca-Cola. These brands command premium prices because customers trust them. Look for patents and proprietary technology. Pharmaceutical companies with patent-protected drugs have moats. Software companies with network effects have moats. A network effect means the product gets more valuable as more people use it. Facebook, Visa, Mastercard all benefit from network effects. The wider the moat, the safer your investment. But there's another critical component: management quality. The castle towers on the slide represent leadership. Even the best business can be destroyed by bad management. Look for leaders who allocate capital wisely, communicate honestly with shareholders, and execute with discipline. Read the annual shareholder letters. Watch earnings calls. Do the executives own significant stock in the company? If management isn't invested alongside you, that's a red flag. Great businesses with great management are the investments that compound wealth for decades. Capital allocation strategies fall into 2 distinct camps: cannibals and breeders. Understanding this distinction helps you identify what kind of returns you can expect from a company. Cannibals are companies that buy back their own shares. When a company repurchases stock, there are fewer shares outstanding, which means each remaining share represents a larger piece of the company. This increases the value of your equity without you having to do anything. Apple is a famous cannibal, buying back billions of dollars in stock every year. This strategy works best for mature companies with tons of cash and limited growth opportunities. Breeders, on the other hand, reinvest profits for expansion. They're building new factories, entering new markets, developing new products. Amazon was a breeder for years, pouring every dollar back into growth. This strategy works best for younger companies with massive addressable markets and high-return investment opportunities. Both can work brilliantly. Both can fail spectacularly. The right choice depends entirely on the company's growth stage and opportunities. A mature company that tries to be a breeder often wastes money on bad acquisitions. A high-growth company that acts like a cannibal misses its window to dominate. As an investor, you need to evaluate whether management is making the right capital allocation decisions for where the company is in its life cycle. Learn the difference between a cheap stock and a stock on sale. This distinction will save you thousands of dollars in losses. Cheap stocks are cheap for a reason. They have poor fundamentals, declining businesses, incompetent or corrupt management, or all three. A stock trading at $3 might seem like a bargain compared to one trading at $300, but that's not how it works. If the $3 stock is headed to zero, you haven't saved money, you've lost everything. Stocks on sale, however, are quality companies temporarily undervalued by the market. Maybe the entire sector is out of favor. Maybe they had one bad quarter and investors overreacted. Maybe there's short-term uncertainty that has nothing to do with the long-term business fundamentals. These are opportunities. The company has strong fundamentals, a solid balance sheet, good management, and a competitive moat. But for some temporary reason, the market is selling it at a discount. That's when you buy. But you need to do the work to know the difference. Look at the metrics we discussed earlier. Analyze the balance sheet. Understand the business model. Buy quality on sale, not garbage at a discount. One of Warren Buffett's most famous quotes: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Remember that. Position sizing determines how much capital to allocate to each investment, and this is where risk management becomes real. Position sizing is the difference between a setback and a catastrophe. Never bet the farm on a single stock, no matter how confident you feel. Here's why. Even the best investors are wrong sometimes. Even Warren Buffett makes mistakes. If you put 50% of your portfolio into one stock and it drops 60%, you just lost 30% of your entire net worth. That's devastating, and recovering from it takes years. Smart sizing protects you from catastrophic losses while still allowing upside when you're right. A common rule of thumb: no single position should represent more than 5 to 10% of your portfolio when you buy it. For most people, 5% is safer. If you have 20 stocks at 5% each, one of them can go to zero and you've only lost 5% of your portfolio. That's survivable. You can recover. But here's the key. As winners grow, you can let them become larger positions. If a stock you bought at 5% grows to 15% of your portfolio because it tripled, that's fine. You're riding your winners. The rule applies to initial position sizes, not to positions that grow through appreciation. Size your positions defensively, let your winners run, and cut your losses when you're wrong. That's the formula. Bear markets separate amateurs from professionals, and understanding this will determine your long-term success. When the market drops 20, 30, or even 50%, amateurs panic and sell at the bottom. They lock in their losses, swear off stocks forever, and miss the inevitable recovery. Professionals do the opposite. The drought playbook teaches you to stay systematic during downturns. First, keep investing. Don't stop your automatic contributions just because everything is red. In fact, increase them if you can, because you're buying quality businesses at fire sale prices. Second, buy quality at discounts. Make a list right now of 10 great companies you'd love to own if the price was right. When the market crashes and those companies go on sale, you'll know exactly what to buy. Third, remember that downturns are temporary, but wealth building is permanent. Every major market crash in history has been followed by a recovery and new all-time highs. The Great Depression, the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, every single time the market came back stronger. If you panic and sell during a crash, you turn a temporary decline into a permanent loss. If you stay calm, keep investing, and buy the fear, you position yourself for life-changing returns when the recovery comes. And it always comes. Inverse ETFs allow you to profit when the market falls, without the complexity and risk of options trading. This is an advanced tool, and I want to be very clear. It should be used strategically, not recklessly. Here's how it works. An inverse ETF is designed to move opposite to a major index. When the S&P 500 drops 1%, an inverse S&P 500 ETF rises 1%. It's like a seesaw. One side goes down, the other goes up. Why would you use this? Hedging. If you believe the market is overvalued and due for a correction, but you don't want to sell your long-term holdings, you can buy a small position in an inverse ETF as insurance. If the market crashes, your inverse position gains value and offsets some of the losses in your main portfolio. If the market keeps rising, you lose money on the inverse position, but your main portfolio gains even more, so you're still ahead overall. The key word is small. Inverse ETFs should be a small percentage of your portfolio, used as short-term tactical hedges, not long-term holdings. Why? Because of something called decay. Inverse ETFs are designed to track daily movements, and over time, their performance can drift significantly from what you'd expect. Use this tool strategically, not recklessly. Use it as insurance, not as a primary investment strategy. Leverage amplifies both gains and losses, and it's one of the most dangerous tools in investing if you don't understand it. 1x leverage is standard. You put in $1, you get $1 of exposure. 2x leverage doubles your exposure. You put in $1, you get $2 of market movement. 3x leverage triples it and triples the risk. If a 3x leveraged ETF tracks an index that goes up 10%, your position goes up 30%. Sounds amazing, right? But here's the deadly part. If that index goes down 10%, you lose 30%. And because of how the math works with daily rebalancing, leveraged ETFs experience something called volatility decay. If the market goes up 5% one day and down 5% the next, you'd think you're back to even, right? Wrong. With leverage, you're actually down. This is why the rule is absolute. Use leveraged inverse ETFs only for short-term hedging, never for long-term holds. Days or weeks, maximum, not months or years. Leverage is fire. Used correctly in small amounts for short periods, it can be a useful tool. Used incorrectly, it will incinerate your capital faster than almost anything else. Respect it or get burned. Hedging protects your portfolio during uncertain times, and it's one of the most misunderstood concepts in investing. Hedging is insurance, not speculation. You don't hedge because you think you know what's going to happen. You hedge because you acknowledge that you don't know what's going to happen, and you want to protect yourself from catastrophic scenarios. When you see storm clouds forming, geopolitical tensions rising, valuations getting stretched, credit markets showing stress, these are signals that maybe, just maybe, it's time to put on some insurance. Hedging strategies can cushion the blow of a market downturn and preserve capital so you can capitalize when opportunities arise. And here's the key point. Hedging lets you stay invested. A lot of investors try to time the market by selling everything when they get nervous, but then they miss the recovery because they're too scared to get back in. Hedging is smarter. You keep your core long-term positions, but you add small hedges like inverse ETFs, put options, or short-term bonds that will gain value if the market drops. If the crash comes, your hedges offset some losses. If the market keeps rising, you lose a little on the hedges but gain much more on your main portfolio. It's the cost of insurance, and it's worth it. Think of hedging like wearing a seatbelt. You don't wear it because you plan to crash. You wear it because if you do crash, you want to survive. The ultimate return on investment isn't measured in dollars alone. It's owning your time. This is the philosophical endpoint of everything we've discussed today. You can have $10 million in the bank, but if you're working 80 hours a week and stressed beyond belief, are you really wealthy? Wealth is freedom. Freedom to choose how you spend your days, who you spend them with, and what you spend them on. Systems investing allows you to build wealth without constant monitoring, without stress, without sacrificing your life in the process. Here's what that looks like in practice. Automate your investments. Set up automatic transfers from your paycheck to your brokerage account. Set up automatic purchases of your core holdings. Set up dividend reinvestment. Remove the decisions. Remove the emotions. Remove the time commitment. Diversify properly so that no single position can devastate you. Then let the system work. Check in quarterly maybe. Rebalance annually if needed. But otherwise, let compound interest do its job while you focus on what truly matters. Your health, your relationships, your passions, living the life you actually want to live. The goal of wealth isn't to have the biggest bank account at the end. The goal is to design a life of freedom, fulfillment, and impact. Money is just the tool that makes that possible. Build the system, trust the system, and go live your life. That's the generational wealth blueprint.